It has a ring to it, doesn't it, Guji? Well, after a recent good performance from the commodities markets in Japan, many think this might be the time to go defensive, but our next guest disagrees. Joining us is Kamil Stender, CEO Helvetia Wealth. Kamil, good to have you with us. Nikkei 225 above 17,000, but when you get these big hikes in the Nikkei, you also get these sharp drops. Is the market looking like it's running out of steam?
Yeah, I think that the Nikkei market, we're a big buyer of the Nikkei at the moment. I mean, you're right in saying that certainly we're trading up at our 5-year highs for the Nikkei. But if you look over the longer term, since it reached its peak back in 1988, we're up near enough some 65% off that peak. So we think there's still a lot of room left to run in that area. I think more particularly, though, a part of the Japanese market that perhaps hasn't really started to show growth yet, and certainly it's just starting to feed through now, is the domestic recovery. What we're starting to see now is, I mean, certainly Goldman Sachs are forecasting over the next 2 years that 90% of economic growth from Japan will be made up from the domestic recovery. As far as how we're calling for investors to best benefit from this growth, is certainly to look at perhaps domestic Japanese stocks, such as the banks. There's been a lot of restructuring going on with the banks, and these are starting to move nicely forward for us. Also, I think what's a very good play in Japan is to look at the domestic property market, where these particular areas have been, let's say, languishing for some time now, and are really starting to pick up and could be a very successful asset class going forward.
How do you play that, Kamil? It's Ross here in Europe.
Yeah, I mean, there's a couple of ways you can play it. I mean, being here in Switzerland, you know, we do look for best-of-class asset managers. One particular area that we've seen very successful as far as an asset manager is concerned is a firm actually based out of Liechtenstein called CAT. They've had very successful growth rates across the whole of the Japanese market over the past 2, 3, 4 years. And that's expected to continue over the next couple of years. Also, I think if you're looking for an individual stock, you can look at Mitsubishi Estate. I mean, the fact is they own probably half of Japan, and we think they will be best positioned to benefit from this increase.
Kamil, Michelle here in the United States. How much of your money is going to Japan, going to Asia, and how much are you telling clients that they should be putting in other parts of the world or in the United States?
Yeah, I mean, if you're looking for asset allocation, we think Japan, certainly we're overweight. Other areas of the market that we're thinking perhaps have seen a lot of profit, and maybe it's time to take some of that profit off the table, is certainly the US. I mean, the US is obviously, the S&P is up near 4 or 5 year highs. You may have seen it has come off over the past month. It's at its lowest level in a month now, the S&P. One of the problems we have with the US market is certainly that consumer spending is beginning to slow. The main reasons behind that is, of course, we've got rising energy prices. We've got, of course, that the personal savings rate has now, for the first time since 1933, in fact, during the Great Depression, has fallen into negative territory. What this, of course, means is that the US consumer is now spending more than they are earning. We're starting to see this actually feed through into the figures. You may have seen in February, the month-on-month consumer spending growth was at a meagre 0.1%. That compares to the rather robust growth we saw in January of 0.8%. So with 2/3 of the US economy made up from consumer spending, we think that perhaps the time has come to take some money off the table in the US markets and certainly look at faster growing areas, which includes, of course, Asia and certainly Japan, which we think is perhaps a little bit less risky than some of the emerging Asian markets.
Okay, Kamil, we hear you. Thank you very much for your views today. Good talking to you. Kamil Stender, CEO Helvetia Wealth AG.